We have Feroze Azeez of Anand Rathi Wealth joining us. Feroze, good morning. We're seeing a good buying interest in the markets given the 90-day pause in tariffs also. But do you believe that this could also be short-lived because the fear could maybe come back as we approach the end of 90-day period?
Good morning, Lavisha. I personally think that this may not be short-lived. Now, when I say that, I'm not implying that the markets can't show you 23,000 or back to 25,000. So that kind of range, I think, has to be an acceptable range, especially from an investor standpoint who even has 6 months to a year on the direct equity side. So point one, do I think this is a very short-lived bounce back? No, because this is a bounce back which is not derivative led. Why do I say so? The short positions were 80%, 79% about 15 days back in index futures for FIIs. Today it has got unwound. The short positions have got unwound, and the short position are down to 59%, which implies that only 21% is 20%, close to 20% is short covering. The rest of it is absolute cash market buying. It could have also been that in the same 10% rally from the lower levels just in the April first week, if the unwinding of short positions was significantly more than this, that implies 80 down to 40 or 30, then I would say this was a derivative-led rally. Derivative-led rallies are short-lived because those are pressures put on a certain class of investors who have expressed a bearish position and they caught on the wrong foot. So that's point one. Point two, the earnings which will get some finality in the next 10, 15, 20 days. 7 companies of Nifty, 32% of Nifty has declared results. There's been a 5% growth. But I think we should be able to end at 1,030 as the earnings for this financial year, which has just gone by. My estimate was 1,049. So earning support and a cash market led rally makes me believe that you seeing those 21,885 levels, which is what was the last year's low on 4th of June, doesn't seem to get broken. And that's what I think an investor should worry about. If he's worried about 4-5%, then FD is the best place for him or her to be.
Okay, Feroze, the street is banking on about 11 to 12% net profit growth for Nifty in FY26. So, have you do you have an upward projection of what the street is banking on, or what is your estimate for the corporate earnings growth we have seen so far?
See, when we speak of growth numbers or any earnings numbers, we go one step first. We look at 1,154 as our earning estimate, which is a summation of the weighted average of each of these 50 companies. So we go deep down, look at the best analyst on the street, try and read reports and come to 1,054, which implies that if we close this year at 1,030, then the growth would be larger. If this year's estimates are met and 1,049 is met, then the growth is almost about 8 to 9%. If the estimates are not met and if this base is 1,030, then I will look at 11-12% earnings growth for Nifty. And I personally believe that we don't believe in upgrading at this stage. We look at results quarter on quarter and the scoreboard keeps ticking, and then that's when I think we will revise it. So we've gone into the year with 1,154. That's the number to remember from our side.
Okay, all right. Feroze, if we look at 6 months data, banks have been one of the outliers in the market. Would you say that this is the time to book some profits given we have seen a good upside in selective counters?
If an investor has a perspective of long-term equity investment, banking I don't think is a sell at all, because it constitutes to 27.4% of Nifty. That's the heaviest weight, financial services, the heaviest weight in Nifty. So I personally think banking is still undervalued, not undervalued. It has discounted the biggest challenge which the banking sector will face in the years or a decade to come, which is the net interest margin compression. So I personally think that's already provisioned for. That's why you see CPs on 2 sigma lower than its mean and medians. Even P price to book is at 1.5 sigma lower than mean and median. So coming back to the point, I would say that that's the base of the cake. You can't get rid of it, at least at these valuations, unless the valuations are 1 sigma higher than the mean. I wouldn't remove the largest sector from my portfolio if I was playing direct equity, even from a year standpoint.
Okay. Feroze, what is the next sector that you're overly bullish on at this point of time? Because you did mention that this is not the time to actually book profits on banks for a longer term horizon. So what else are you watching out for?
I'm watching out from a 2 year perspective, oil and gas. If you look at the Nifty oil and gas index, I think that's been beaten down reasonably. I think sometimes when earnings don't come up, show up, and then emotions take over. Sometimes you go to the other extreme of valuation. I think there is a lot of merit in owning oil and gas in your portfolio. If you really don't want to be bothered about picking up stocks in the individual sectors which we are speaking about, you always have a great proxy in terms of Nifty oil and gas index that should outperform Nifty by about 4%, 5% per annum. If that's the objective for a portfolio, then I think that will be a good sector, which is definitely difficult to buy because it's very difficult to buy low and sell high. It's just the opposite which your heart makes you do. It always makes you buy high and sell low. So if you have the courage to do what books tell you, then that's the sector to go for.
Okay, all right. Feroze, what about the IT sector? Because, last week we did see a good upside, but the managements of the majority of the companies have indicated a very cautious FY26. Do you believe that this is already in the price, or is there more downside which could be anticipated from the sectoral perspective?
See, Nifty IT index has about 10 companies. If you look at its growth for the first 9 months, is 14.5. I think IT has generally had this cautious approach in terms of management because those are one of the largest companies, well managed. So I personally think IT is something which I would own from a 6 months to a 1 year perspective.
Okay, all right. And what is your take on the mid cap and small cap counters? Because do you believe that there is still a bit of froth left in those counters? Because we have seen a decent correction, but do you believe that there are selective counters which are trading in terms of premium, in terms of valuation perspective?
Yes, Lavisha, I personally think we are very, very close to converging, coming to some kind of an equilibrium in all these three segments. That equilibrium was disturbed. I think the correction of this calendar year especially has brought in some parity at an index level, point one. Point two, since an index of a small cap index, from when I say small cap, I refer to the Nifty small cap 250 index because there's so many indices these exchanges have created. But from a mutual fund standpoint or any institution, domestic institution tracks NSE small cap 250. Any basket of 250 stocks should ideally be bottom up and not top down. Firstly, from a top down, my comment is equilibrium is fast approaching or is already behind us. Point one. Point two, it is always going to be bottom up, making generic statements for a 250 stock index, especially in diverse businesses with different pricing models. I would not do the mistake of painting them all in the same brush. Now, third, how do we look at it is if you're really keen to own stocks, then these stress times are great data collectors for you. We generally operate, I at least do a back test of a strategy which has paid off very well, is nothing but in a bad market. Let me lay down these three steps of evaluating or creating a portfolio in a circumstance where there's uncertainty. Step one, go back 6 months, 1 year. Look at the worst days, more than 2%, 3% fall days. On those days, list down all the stocks which were positive in NSE Small Cap 250. Once you will get a list of stocks which are positive, arrange them in the descending order of positive, and then see if there were 10 days where the market was worse off. There were, in those 10 days, you get the list of positive stocks. See the commonality. If there is a stock which is common in several of those instances, then keep that aside. And that proves the hypothesis that the owners of this business are not driven by market movement. Whenever uncertainty is there, you have to buy businesses where the ownership is very strong. How do you establish ownership is strong? Is doing a stress test. Stress tests are bad days, positive stocks. If that is a common nature of that specific business, that means if there is 5,000 crores of free float, that is owned by people who are not driven by what Trump is doing, what is going to be the war. It's going to be more business-led. So when markets are bad, buy businesses. When the markets are good, buy price. And I just told you, these are times to buy businesses and not buy the momentum and the price.
Okay, all right. Since we discussed about banking names also, Feroze, what is your take on NBFCs? We have seen that there was a significant slide in Shriram Finance stock price after it reported lower than expected results from the street front. So what is your overall view on the NBFC space given that we are seeing a stress of microfinance too?
See, I personally think it doesn't. NBFCs are very high beta and they don't justify the differential return. So if you calculate the Jensen's alpha of these two banks vis-a-vis NBFC, you'll be disappointed with the NBFC set arranged in the top five NBFCs, the beta they produce or the risk they produce and the extra return they give you vis-a-vis Nifty. Jensen's alphas are very poor. So I am an eternal from a capital allocation standpoint, not a stock or something. If I have to allocate capital, I try to allocate capital on risk-adjusted return basis. And NBFCs have not passed that litmus test of Jensen's alpha, so I stay away from them.
Okay, stay away from them. Feroze, you did mention that you are bullish on oil and gas sector from a three-year perspective. Anything that you are seeing on staying on the sidelines apart from the NBFCs?
No, I think I personally think FMCG might not be as deservingly richly valued as it's supposed to be currently. So I would say I would be bearish on FMCG. I think it's basically the lesser supply of free float results in these FMCG stocks having a larger price to earning multiple, and I think that's structurally something which I cannot bring my mind palatable. My mind is not palatable with those kind of valuations for some time. So I would be bearish on FMCG.
Okay, bearish on FMCG right now. But with that, we have to let you go, Feroze. Thank you so much for your time, and we hope that we connect with you soon.